Hello everyone and welcome to Pivot Boss Masters and our core training for core trade management techniques. This is part of the execution portion of core training, and core trade management techniques is kind of the essence of our trade management approach. It's basically our core techniques here. We got four key techniques or core trade management techniques that we like to use. And from there, we're able to then use creativity to be flexible in how we use those techniques or how we use them throughout the life cycle of our trades. So core trade management is very important. As we talked about in our previous section with risk management, you have to be able to manage and mitigate risk whenever you can. And for the most part, we talked about how there's a process of risk, either accepting it, avoiding it, transferring it, or reducing or offsetting it, right? And with regards to the core trade management techniques, this is a process that first helps you accept that initial risk. You know, when you get into a trade, you know that this is the maximum risk I'm willing to take on for this trade. But as a trade continues on, our core trade management techniques are designed to then reduce that risk throughout the life cycle of that trade. And so as price continues in your favor, you continue to reduce size, and from there you're effectively transferring risk over and reducing it, and ultimately taking it off the table. And that's really the process with core trade management techniques, is just giving you those quick techniques that allow you to enter and exit, or rather after you enter, allow you to manage the trade on the back end with skill. It gives you an automated type of mechanical approach to engaging trade management. So let's go ahead and get started with core trade management techniques. So our core trade management techniques are designed to provide consistency, reduce risk exposure, and offer flexibility. These techniques can be used for any setup in any time frame with any account size. And again, I created these techniques, and I created every single concept and technique in the Pivot Boss method to be scalable. That was very, very important to me. One of the pitfalls I've heard of traders before was the inability to scale certain approaches, whether it's trade or risk management or entry or setups, from lower time frames or smaller account levels into higher time frames and bigger account levels, right? And so I wanted to preempt that many, many years ago by saying, you know what, if I find an approach that's successful for me, I want to be able to scale that approach to higher time frames and managing bigger sums of money. So that's what this was all about, because if you have a personal account where you're just now getting started, you might have $5 or $10 or $20,000 in that account. Well, each of those price points allows you to trade a certain amount of money and control a certain amount of money, but at the same time, you don't want to have different risk approaches to every single one of those account sizes. Instead, you want to apply an approach that's an all-purpose approach that can be used for all account sizes. So when your account does grow, you can continue to do the things that helped you grow that account. It's the switching of strategies and changing of approaches that really hinders a trader's ability to consistently make gains in their accounts. And so, that's a pitfall that I've always come into every once in a while, is that once you make so many gains and strides, as you look to improve or gain an edge, you change certain things. And when you change those things, you actually see that those things were helping keep together your success streak, right? And so you start to learn what's important and what's not. When it comes to core trade management, what's great about these techniques is it has so many different advantages. They're very, very simple, but the advantages are numerous. Number one, they're great all-purpose trade management strategies, which means you can use them for all types of trading scenarios, whatever instrument you may trade or whatever time frame you may trade. So if I'm a stock trader, if I trade options, if I trade futures, if I trade currency futures, I can use the same approach. If I trade mutual funds, again, if I trade ETFs, these core trade management techniques are scalable and give you the flexibility to trade any of those environments and manage your risk in a very risk-appropriate manner, a very risk-averse manner, so that you're scaling quickly and alleviating that risk, taking it off the table so that you can have a clear mental state throughout the rest of the trade. Number two, these are perfect for traders of all account sizes. I mentioned that before, and it's designed to be scalable to any account size. Because when I was first starting trading, my account size wasn't that big. Being a college student back then, I had to learn how to trade for that account size, and then I had to learn how to deal with the success of a growing account, and also deal with the challenge of an account that goes against you. Right? You have to be able to manage accounts, manage your trades in so many different ways and different types of circumstances that come your way, because there will be ebbs and flows. But you have to be able to adapt quickly so that you stop the bleeding, or adapt quickly so that you take advantage of those times when you're knocking it out of the park. Number three, these are designed to reduce and eliminate risk immediately. That's the core philosophy behind these core trade management techniques. It's reduce or offset or transfer the risk immediately. So you scale out of positions to reduce risk. That's the approach that we're using. If you recall before, we talked about risk management process. And the risk management process was about identifying the risk, assessing that risk, finding strategies to control the risk, and then from there, reviewing those controls. Well, this core trade management and these techniques are the controls that we use to manage our risk. And then what we do is just apply these controls to our trades. And from there, as soon as price moves in your favor, what we're doing is reducing that risk by scaling, taking some off the table, taking half off the table, taking a third off the table, taking a fourth, or whatever you want, you can take off the table, taking 2/3 off. Each of these are designed to take some unit off the table so that you are effectively reducing that risk right out of the gate. And what that does for your mental clarity is huge, because you can have the perfect mental state heading into a trade, and then as soon as you enter that trade and execute in order to enter that position, your mindset and everything goes haywire, because risk is now attacking the brain, and that just does certain things chemically in your brain that just, for certain people, it can make things crazy. So how we combat that as traders is by using a consistent approach to trade management, so that when we're using one of these techniques, it's automatic. It's like a robot or a machine. It's, oh, I like this entry. Here's my entry trigger. Okay, boom, I'm in the trade, and now let the trade management go. It should be the easiest part of your trade. So with regards to the automation and just making things automatic, what that's designed to do is remove the emotion from the trade. That's number 4. So using these techniques for every trade creates a mechanical approach to trading, which helps remove emotion by creating a sense of merely doing your job. If you see a trigger and you know that that's your trigger to enter that market, click the enter button, transmit, transact, whatever you have to do to get into that trade, and then let the trade management take over. And from there, it's like a machine. You pull the trigger and you just let it operate. The results will be what the results will be, but you have done your job up to that point. What these are designed to do is designed to inspire confidence by booking consistent profits. And that's important, because too often, I think, novice traders, when you enter a trade, what you see is price go immediately against you. It hits your stop loss. You lose money. And that happens way more often than we would like at the beginning of our trading careers. So you get used to entering a trade and having your stop run. Entering a trade, having your stop run. It's the opposite pattern that you want to create. Instead, obviously, you want to book profits quickly at the beginning of your trade. And that's what these scales are designed to do. Your T1 targets. T1 is target number 1. T2 is target number 2. T3 is target number 3. Each of these are designed to scale at a quick early T1 target. So as soon as price reaches T1, ideally, that target is going to be, for the most part, equidistant to the distance between the entry and your stop. So whatever the distance is between the entry and your stop, that same distance project it toward your target from the entry, and that's going to give you typically speaking, a T1 target with regards to these techniques. And so once you reach that T1 target and that order is filled, your risk for all intents and purposes is off the table. I mean, there's other types of risk that you have to be watching out for, but with regards to the initial risk of the trade, you've already wiped it out because you're taking some off the table. And so that's extremely important, because now you are consistently booking profits. So instead of taking that first loss, what you're looking to do is book that first profit. As soon as you're booking profits, now you know that as soon as you reach that T1, you're golden. And again, that was a change that I made so long ago when I reference the techniques that helped me really revolutionize some of my trade management. When I went on a streak of 3 straight weeks without having a losing trade, whereas up to that point was hit or miss, really good or really bad, or somewhere in between. I went 3 straight weeks, and it was basically using an 11 scaling technique. That was basically it. That was the technique that started me off, was the 11. Scaling half at a T1 target, and then scaling the second half at a T2, or letting it ride if it was a big winner. That was it. And so as soon as I got to a T1 target, what I saw, the reason why I didn't have any losers for 3 straight weeks, was because I was either making money or I was hitting break-evens. Making money or hitting break-evens. Making or break even. Making or break even. And so you can see when you're doing that over and over, there's really not much room to lose money unless you're hitting a full stop loss. But these T1s are designed to get you to that first target very quickly so that you alleviate that risk right off the top. What do you commonly use as a T1 target for an ES trade? So I mentioned earlier in the trading room that I typically have a stop loss of somewhere between 8 and 10 ticks in the ES, usually around 6 to 8 ticks. So let's call it 8 ticks, right? If I have an 8 tick stop, that's 2 points, then typically speaking, I would be looking for a 2-point T1 target. That's what I'm looking for. So in the trading room, that's why I'm usually saying, hey, look for a 2 to 3 point rotation. If you enter a trade, if you can get a 2 or 3 point rotation in your favor, you can scale and be really good as a trader. Because if you can always enter a trade and forecast that next 2 to 3 point move, you can make a good amount of money, because you can create a scaling technique or some sort of trade management approach that allows you to capitalize off that swing. I always talk about that story where that big ES trader would come by the office back when I was working for the software company, and that trader would come by and he would say, hey, Frank, you're making me so much money. I'm buying and selling 1,500 ES contracts on your call, and all I'm doing is looking for 3 points. If I get 3 points, I'm out. If I lose 3 points, I'm out. But your analysis always helps me get 3 points, and I'm swinging 1,500 contracts on it. And it was like, wow, that helped change a lot of things for me as well, because that's when when true pros know how to use your analysis to make more money than you are at that time. It's because they know how to approach the market. They know what it takes at times to find that edge and manage their trades in a way to take advantage of that edge very quickly. With regards to these techniques, again, I'm looking for a quick 2-point move, 2 to 3 point move in my direction for the ES, and then I scale at a T1. And from there, it just depends on the duration of the trade. And that's why I say also, even if I enter a swing trade in the ES, I'm still using scalping approach, and then I let or force that position to prove to me that it can graduate into a swing trade. Now that creates, it creates for stricter rules for allowing for a swing trade from time to time. But when you nail that entry and you're in, and you're able to get in with little to no adverse excursion, I mean, that's the whole part of the game sometimes, is being able to identify and pinpoint those areas where a rejection is likely to occur. And then the trade management is just about pulling the trigger and letting it do what it's going to do. So these are designed to inspire confidence. So booking consistent profits while limiting losses helps to build confidence in your approach and skill. And, confidence begets confidence. Profits beget profits. And that's why I say this approach is designed to help you book profits, not lose money, lose money, lose money. You have to change the pattern, right? And that's what these are designed to do. And these are perfect for traders struggling with consistency, like novice traders, as I was many years ago. I mean, I was struggling for consistency where I would hit home runs and then I would have huge losses too. Nothing in between, because I was trying for home runs. And when you try for home runs, you also strike out a lot, right? And so what this approach is designed to do is not look for home runs or strike out. It's looking for singles and doubles, singles and doubles, singles and doubles. And if a triple or home run comes of it, then so be it. But it's singles and doubles, and that's what this is all about. And so when you are struggling with consistency and you start using an approach like a two-part trade management, the 11 scaling technique, I mean, that's the first one right there. I call that one the free trade technique. And as soon as you hit your first target and you scale half, you leave the original stop in place, and now you have a completely free trade. You can leave it on for the next 100 days if you want to, as long as it doesn't hit that stop. Then you're still in. It's completely free, right? So that's the technique, again, that helped me figure out consistency. And from there, I looked to improve it and modify it, and then came up with other techniques as well. And these also did, for the most part, these aren't things that I thought of myself. I mean, other traders approach it this way as well. These are the approaches that I gravitate to the most, but you'll see other professional traders in other trading rooms or other traders in general that will apply these techniques, and they do it with discipline. That's the point. That's what separates consistency from non-consistency, is the discipline to stick to the technique, the discipline to stick to what's happening with the process of your trade management technique that you're using. It's sticking to it with discipline. And that's why I said before, especially with regards to risk management, I mentioned automating entries and exits. Automate the process, and because it's going to eliminate all of the execution risk that can happen, and things are going to flow much better, because it's you're eliminating the trader risk as well. If you don't mind telling us, Frank, how many months, years did it take you to become consistent? It took a long time, and see, it took a long time, and I'm trying to think back now, because if you'll recall, I'd been doing this for a very long time with regards to studying the market, and I had studied the market from middle school, right? And I was that kid who studied it, and but I didn't open my first account until I was in college. I was 19 years old. As just finished my freshman year. Again, I studied the market that first year, and then that summer after the first year, that's when I opened an account. And since it was the late 90s, we can't confuse consistency with someone who loses money, because even though I was inconsistent, I was trading during the late 90s where everything was going up, like a lot of traders, right? And so it was very easy to pick something and just hold on and watch the thing just rally. But that didn't mean I was a great trader, although I was making money, right? But that making that money up front gave me the flexibility, and it afforded me the time to be able to, learn a consistent approach without losing my shirt to begin with. Because usually it's the other way around. You start a 20 grand account, and you take it down to 1,000, and you're like, oh crap, and now you got to start over. I was lucky in regards to that, because I started a smaller account and quickly grew it up because of the late 90s, and then from there I watched it come back some, and then that's when I started to battle with consistency issues, because when I was earlier trading, it was more position and swing. I wasn't a day trader when I first started. It was day trading. I still had to call the broker to make a trade, or drive my car to their office to make a trade. So it wasn't day trading back then in the late 90s when I was engaging it as a college student. It was all swing and position trading. I mean, I was even holding on for a year on some of these trades. And so it was different. So I wasn't pulling that many trades to be that inconsistent. But then when I started becoming a day trader, then yes, it took several years. I mean, several years, 3, 4, 5 years. And even then, dealing with things that happen, like I say, dealing with a success and then all of a sudden seeing a big 2-week correction in the equity curve because you get hot-headed and overconfident. It's those things that you start to deal with. So there's always something that you're trying to challenge that you're overcoming, but it's the ability to identify that challenge right away, quickly, and adapt right away. But here's the deal, Southpaw, as well. I did a lot of this was self-taught. A lot of it was self-taught. And even though I worked at an institution where we built these platforms, a lot of the folks that worked there were programmers, designers. They weren't all traders. So I had to be the one to try and navigate through all of these things and try to figure it out as well. So I was never really taught a lot of these aspects like trade management, but I was taught forecasting, so I excelled at forecasting right away, but I wasn't great at trade management because I wasn't taught these things. I had to learn these things from experience. So the point is, by going through a course like we're doing here at Pivot Boss Masters, like a core training over the last 2 weeks, if I had something like this when I first started, I think it would have taken a lot less time to be consistently profitable. Does that make sense? I mean, if I had something like this right off the bat that said, this is how you enter a trade, this is how you scale, this is how you prospect, this is how you prepare and homework, you would reach your goals a lot faster. But that wasn't the case for me. I had to create and navigate and develop, and I had so many different things pulling me in so many different directions because not only was I trading personal accounts, but I was trading family accounts, and I was trading institutional accounts and creating algorithms and trading automated accounts. It's a lot. So it's a lot to do. Fortunately, not everyone has to deal with all of those various situations. So, you can focus and just grab the great juice and meat that I'm giving you right now. And from there, I mean, it's all about practice and execution and refining the approach to suit you. So I love this approach. Again, the 2-part trade management and 3-part trade management approaches. My favorites are 211. I love a 211 scaling technique. The 11 scaling technique is always fantastic. That was my first true love scaling technique. And then the 3-part 11 scaling technique is fantastic. You'll see a lot of the base professionals use that. It's a 3-part scaling technique, 1, 1, 1. 1 unit, 1 unit, 1 unit. Each of those units can contain however many contracts or shares you want. So, right here, what you're saying is if you have 1 unit right here, that can be 3 contracts. This can be 3 contracts and 3 contracts. So you're trading 9 contracts total. If you're doing stocks, this can be 100 shares, 100 shares, 100 shares, right? It could be whatever you need it to be. So these units, that's why I say you can scale. So as your account grows, then you can continue to use the same scaling approach that brung you there, as they would say here in Texas. Dance with the one who brung you, right? But you don't have to change anything. All you're doing is ramping up the contracts. So if you start off with 1 contract apiece, but as your account grows, say you take your account from 10K, to 20K, then you can start trading 2 contracts a pop, in each scale. And as you grow it some more, then you're trading 3 contracts per unit, right? And as it grows, now you trade a little bit more. So the technique stays the same, but you're scaling it to the size of your account. You're not changing anything except for the number of contracts or shares that are being transacted at the unit. And that's what makes this approach so powerful. So when I say that you can make a lot of money out of trading a 2 or 3 point rotation in the ES, it's because if you can consistently get that 2 to 3 points with minimal adverse excursion, right, then you can trade 10 contracts in each unit. You can trade 50 contracts in each unit. You can trade 100 contracts in each unit and just snatch that little 2 to 3 point rotation, right? So You don't have to hit home runs. You don't have to say, I just made a 30-point ES trade. A lot of professionals will say, man, why were you holding on so long? Because, let's get the quick move. Let's put a lot of contracts on it, and let's make some money. A true professional, on the floor would rather throw 50 contracts and get a 2-point move than throw 5 contracts and get a 20-point move. You know what I'm saying? There's a big difference sometimes. The 20-point moves don't come around that often in the ES, but the 3-point moves do. So it's just, it becomes a philosophy, but it becomes something where you have to tune your mind to it and know what you're looking for. Yes, that's right. That's right. So if 8-tick stop is used, T1 is 8 ticks, 1-to-1 no matter what you use. So we're going to look at some charts now so that we can demonstrate this. But the idea is that if you're using this approach or this approach where you're going half and half, then yes, it would be basically 1-to-1. 1-to-1. This one would also be 1-to-1, but then after you scale, then you kind of adjust your stop somewhat. But yes, for the most part, it's 1-to-1 on this end. So before we go ahead and jump into the charts here, Paul Tudor Jones, again, one of the greatest traders around, hit a little bit of a rough patch so far this year, but at the same time, many of the principles he talks about just holds true. Don't focus on making money, focus on protecting what you have. And that was another big aha moment. It was stop trying to hit the home run all the time and start worrying about or correcting the issue of taking such big losers, right? Protect it. Protect the money instead of trying to hit the home run. Too often, again, as I mentioned, if there was a level here, I'd get long, and I wanted this all the way. And I didn't want to scale. I wanted all 100% of that position up here. But in order to do that, you got to widen out your stops, right? So I would let it sit there all day long trying to get that thing. And if it did that, now I'm out, right? That was how I started trading so many years ago. And now it's not like that at all. It's much more skilled, much more precision entries, much more tactical. And that's kind of what it takes. It takes that ability to be precise, know where your level is, and then execute like a machine. Let's go ahead and take a look here at some of these examples. So here is a 3-part scaling technique, and this is the 211. This is the 211 scaling technique. And we'll go through 1, 2, and 3 steps here all the way over. So this is the 211 scaling technique. This is what I mentioned. This is one of my favorite techniques. If I have any technique to trade, it's this one. And it's this technique because it offers a whole lot of flexibility. The first thing to do is when you enter a 211 scaling technique, remember you're trading 4 units. So whatever size you're trading, it needs to be divisible by 4. So for example, if you're trading 100 shares, then 25, 25, 25, 25, right? That would be each unit. If you're trading 4 contracts, it'd be 1 contract in each unit. So it needs to be divisible by 4. And then once you enter a trade, wherever your entry may be, say our entry was right here at 72.25, prices formed a low here, and then you saw a rejection, and prices, started to squeeze. Right here, if you got in at 72.25, you have an 8-tick stop here. This is showing a 4-tick exit. So in this case, what it's doing is it's saying here, give me an 8-tick stop. So it's a 2-point stop in this case. Usually I like to do a 1-to-1 here on the first one, but in this example, it's not showing that. So if you enter right here and price goes up, you want to get your first target, wherever it may be. There it is. That's a plus 8 ticks by scaling 2 contracts. So when price goes in your favor right here, from here to here, and goes up 4 ticks, in this case, you're taking half off the table, right? Because it's a 211 scaling technique. So you take 2 of the 4 units off. 2 of 4 is half. So you're taking half off the trade right here. And by taking 2 contracts off at that level, that's giving you a plus 8 ticks, right? 4 ticks times 2 contracts. So that's a plus 8 ticks. And what that happens now is that by making a plus 8 ticks right here, Now on your last half, you can have a minus 8 tick stop, and then you're going to lose $0. So when you go over to the next over here, to the next slide, you can see right here, after making that first T1 exit here, now you lose $0. So now as price moves along, you see right here, you hit that one. As price moves along, here's your T3 right here. Here's T3. And at that T3 right there, you can see you took some more money off the table right there. You take more money off the table. So what I like to do, again, is once you get to a quick, highly confirmed T1 target, you take half off the trade. In this case, it's 2 units of the 4, right? And then once you go up a little bit farther to a confirmed area that you want to, take off the table, perhaps you reach a prior resistance level, like right here. You can take some off right ahead of resistance and take another quarter off, right? So if it's 211, you've already taken this one off at T1. Now you're taking another quarter off here at T2, wherever it may be. I like to front run a key level. Maybe it's back at value, so it could have been here, right? Maybe it's VWAP, and that's what you do. And then once you get 3/4 of the trade off right here, you can keep a runner to continue on toward a farther target, or and just hold it the rest of the day. Remember we talked about advancing the base runner, and that's one of those concepts there where basically you've scaled out up here, you've made money along the way, and now this last quarter position up here, right, can just run off because you've already made money along the way. And where you want to move your target or stops up to, obviously, as you progress throughout the trade, you'll continue to move a max stop up. But in this case, you just leave a runner on, and that's working back toward T4 perhaps, or just as a runner in general. This is the easiest one right here. Again, this is the scaling technique, and I call this one the free trade technique. This is the 2-part trade management technique called the 11 scaling technique. And it's called the 11 because you have 2 units. You have 1 unit here and 1 unit here, and you scale them in half positions. So whenever you enter this trade again, say you see that rejection here, say there's an imbalance here of some sort, whatever it is, you get into the trade at 72.25. When price goes up, say in this case it was 6 ticks, so say we had a 6 tick stop here. So you have 6 ticks on 2 contracts, that's 12 ticks of total risk, right? So you can see right here, if price were to go from this entry and hit the stop, you're risking a total of 12 ticks. So in order to offset this risk right here and take it to 0, when price goes up 6 ticks, take half off the trade. Take half off the trade. And that means take 1 unit off at +6. So once you take 1 unit off at +6 up here, you no longer have 12 ticks of risk here because you've taken 1 contract off. That drops it now to 6 ticks of risk below the entry, right? But since you made a +6 up here, it offsets the remaining -6 here. So that means if you hit the stop, you lose $0. Hopefully you follow, right? So if this is your entry point right here and you get into 2 contracts and price rallies up 6 ticks and you take half off, you just made +6 ticks on 1 contract, which equals 6. So now you have 1 contract left with a stop right here at -6 ticks. By making +6 ticks up here, if price comes all the way back against you after hitting T1, you lose 0 here. So that's how you negotiate into a break even, right? That's how you negotiate. Now say you had another contract and you take an additional leg off up here at T2, right? Then that adding money up here, whatever extra you make up here, you can then subtract it to the theoretical average entry down here. And so that's how, from your entry here, you can get stops that are so far against your entry, even though you didn't place your stop there, you earned that stop by taking money off the front end of the trade, reducing the trade as it goes along. So earning a wide stop is something that you would do on a swing trading position. But this, again, Very, very simple approach here to scaling. So if you look over here to part 2 or step 2 of this 21, here's step 2 of the 11 scaling technique. So now you can see after you successfully take that off right there, you take some off the table. Back here now, look at this. This is 0 now. So if price comes all the way against you, you've lost 0. And then when price comes up here, again, perhaps to the previous high, you can take that final one off. You can also re-enter and do all kinds of stuff and continue on in this trade. So there's a lot of different ways you can do that. So in this case, it's showing you that once you have T2 here, you can take that off at the previous resistance, or you can keep it as a runner, because you can hold it now the rest of the day, and as long as it doesn't hit this price, you know, you're still making money. That price would cause a break-even result. So if you automate so you can walk away, where do you end the trade? That's a great question. There's many ways to do that. And it depends on which, you know, it just depends on the scenario. So there's been scenarios where if I left, one time my brother and sister came into town, and they never really come to town, so it was during the trading day. They were in for a really short amount of time. So I said, you know what, folks, we were in the trading room. I had a long on. I said, hey, everyone, I'm going to keep in this position. I'm going to stay in it because I think it's going to continue higher. It's a trend day up. So I went, and we went out to the lake, and we went on Ladyburg Lake with some kayaks and canoes, and it was a lot of fun. I checked my position, and when I checked the position, it got me out near the high of the day. How? Because I used a time-based exit in that case. So if you automate an exit when you walk away, there are many different types of exits you can do. One of the exits that I always used, in addition to other forms of exits, was the time boundary exit. When the market got within 5 or 10 minutes of the market's close, then get me out of the trade 5 minutes before the market closes the day, wherever it is. And so that was the one that got me out that day. So when I'm on the lake out there, I noticed the market closed. I wanted to make sure that that my automation had taken me out of the position. So I look, it did take me out of the position right when it should have, 5 minutes before the close. And that day, you know, I think I was trading a TF. I mean, that was like $1,100 per contract made on that day. I think I captured like a 11-point move the rest of the session during that trend day. So that was really nice. So there's different things. Other points, again, as we relate other parts of the core training to what we're doing with this particular section, which is trade management, when you're looking to take out that last runner, perhaps you're running price back to the midpoint of a key range, or maybe you're running it back to the previous session's high, or maybe you want price to continue to the previous week's low. So those would be exits that you would automate to take you out of the trade. When price reaches those levels, take me out. If price continues towards those levels but doesn't reach it, but we're within 5 minutes of the close of the day, then take me out of the trade. So that's how it's usually done. And yes, my best trades were always predetermined. And that's where I really switched, and again was another one of those aha moments. Every time I put like a trailing stop on, and I wanted the trailing stop to just take me out wherever, you know, as it goes along, you know, on big, beautiful times where you capture the whole move, it's nice. On the majority of those other trades, you're giving way too much back of those hard-earned potential profits that you had captured during that trade. And by the time it hits your trailing profit stop, it's taken a big chunk of your money. And so when I switched to predetermined targets, it was a much bigger deal. So again, and that's what this approach is about. You know, it's about entering at a point, scaling quickly so that now you have zero risk on the board, and now you allow your trade to work itself out to a predetermined target. You know, you're letting that base runner see if you can get the second, third, and home base. So that's kind of the approach. So there are many different types of approaches here. Again, the 11, the 211, the 21, and the 111. And I would encourage you, I know we just looked at just a few of them here, and we're going to talk more and more about trade management as we move forward and add more videos and chart examples to the gallery. But what you can do here is also go back to the dashboard. Go back to the dashboard and then scroll down to the archived content. So when you go down to the archived content down here, you go down here to Core Trade Management. Right here in the Basic Professional Trade Management, it's actually going to take you through a fantastic presentation where it walks you through every single one of these scaling techniques. So it's 55 minutes where it shows you every single one of those scaling techniques in more detail. And then if you bring up this PDF right here, you'll actually see all the various techniques here, what to do, the things about them that make them unique, and what they look like on the chart. And I'll talk more about those points using some of those same examples we just looked at. So if you want to go back and get a more robust look at some of these strategies, then go watch that this particular video right here, Basic Professional Trade Management. It's pretty fantastic. That pretty much does it for the Core Trade Management Techniques portion. This gave a very, very good introduction to the various core trade management techniques that we use at Pivot Boss Masters, again, including that 211 technique, the 11, the 111, and the 21 scaling techniques. Each of them have their own, strengths and weaknesses. For the most part, they all have the same types of strengths, which is what I really love. The ability to scale, the ability to keep you honest and disciplined and mechanical in your approach to trade management. And the last thing that they really do, which we'll be talking about in the Advanced Trade Management Techniques portion, is the flexibility that these techniques offer because of the various ways that you're able to defend and scale and re-enter trades. It just provides a tremendous amount of flexibility. But the first things first is just getting the introduction to understanding these techniques. And again, we have additional materials at the training library to take you through each one of these techniques as well. So thank you very much for being a part of Core Trade Management, and I hope that these techniques serve you well in the future.